Hi, and welcome back to the Business Career College video series. In this particular video, we're going to look at the corporation. Now, there are a number of reasons why we incorporate, but what we're concerned with for the purposes of this course primarily is the business corporation. The idea of incorporation dates back to around 1200 or so, when we started to see in England, municipalities permitted to incorporate, notably the city of London traces its incorporation back to 1215. For business purposes, we didn't see corporations used until the early 1600s with the Dutch East Indies Company out of Holland. Today, though, the corporation is a very ordinary way to operate a business. So here's what we have with a corporation. You'll normally see it drawn like so, as a little rectangle, and we'll call this just the corp. And so we have a variety of people that are involved with the corporation, but fundamentally the corporation is its own separate tax and legal entity. So this means it files its own tax returns, it has its own tax year, it has its own tax rates. So for all of these purposes, it's a separate entity, and it uses even a different tax return form. It uses a T2, whereas a person normally uses a T1 in Canada. The legal aspects, it's actually considered to be what we call a legal person. And what that means is that it can sue and be sued, it can enter into contracts. It is actually considered to be a separate person for legal purposes. So now we have the variety of people who are involved in the corporation, and it's important to understand this. One of the big considerations around incorporating is that we're going to create this separate entity, but we have to have some people who are involved in this. So first off, we're going to have our shareholder or shareholders. And these are generally either the people who originally put up the capital to create this corporation, or people who have, since the corporation was first incorporated, people who have acquired shares from those people who originally acquired it or from the corporation itself. Now, these shareholders have three rights. They have the right to dividends of the corporation, which is a share of the after-tax profits of the corporation. They have voting rights, which is probably the most important right, and we'll talk about that momentarily. And they also have the right to the equity of the corporation. They're considered to be equity owners of the corporation. That is, they're the ones that would get the assets of the corporation in the event that everything was liquidated and all its debts were paid. Now, these voting rights become important because this allows us to appoint the directors, or to vote for or elect the directors of the corporation. The directors fill their own set of roles here. They have not rights here, they actually have responsibilities. They have in fact, fiduciary responsibility to the corporation. And there's a lot of debate about what that actually means, whether that means they're responsible to the shareholders or to the corporation itself. That's a big picture legal question that we don't really know the answer to. The directors then, in their fiduciary responsibility, are responsible for the day-to-day affairs of the corporation. The day-to-day affairs of the corporation. So they're actually the ones who are responsible back to the shareholders to operate the corporation. And among other things, the directors would decide how much dividends the corporation would pay out to those shareholders. And then we have the people who are actually working in the corporation. So that's where we're going to have our management. And that's people like our officers. So the chief executive officer, the chief operating officer, and so forth. And we're also going to have then our executive, our president, our vice presidents, and so forth. And there's some blend here or some crossover between these for sure. So then, in addition to our management, we have, of course, the staff, the folks who fill the roles that actually makes the corporation be able to go out and do what it does. In a small business, when we're looking at a smaller incorporated entity, it's very common that the shareholder and the directors and the management and the staff are all the same person or group of people. But as businesses grow up and become more and more mature, we start to see more separation at each level here, where we have distinct management staff, directors, and shareholders. So those are the parties involved. So now what we're going to look at are some of the advantages and disadvantages to incorporating. So there are several advantages, and depending on the exact structure we're using, some of the advantages we see to incorporating are this separate legal liability. So if I'm a shareholder of a corporation and my corporation does something that would create some liability, that liability stops for the most part at that corporation. Generally, it won't impact on my personally owned assets. So we have separate legal liability. What else do we have to look at here? Well, we have, generally speaking, this is not universally true, but generally speaking, corporations pay lower taxes than individuals do. We have the ability then to bring in other shareholders, so we can income split based on, for example, if I'm incorporating a business, I would have my spouse as a shareholder and I would be a shareholder, and that way both of us can generate income out of that corporation. There can be some other problems with that, but that is an advantage that we have available. We have other advantages here. We have access to the ability to sell the business or sell the corporation in a tax-favored manner, maybe using the lifetime capital gains exemption, which we'll talk about in another video. This can actually save you a fair bit of taxes. We can wipe out, as of 2014, the first $800,000 of capital gains on the sale of qualifying small businesses. Other advantages to incorporating, we have the ability, some tax advantages here where we can carry forward losses. So if you have a loss in a year, you can actually carry that forward and use that against gains in a future year. Other benefits, we have the ability to defer income, and we can choose the character of our income, where we can choose salary or dividends for our shareholders. So quite a few advantages here, and there are a few more, but those are some of the more obvious advantages to incorporating. And then we would look at some downsides potentially to incorporating, some disadvantages as well. So some reasons why you might not want to incorporate. And you might consider here, I should mention one more advantage, sorry I missed a big one here, and that is the ease of succession. So with a corporation, you create a perpetual entity, and it does allow you then to sell that entity or to give that entity to another party. My disadvantages then, if we'll pop over here, it is expensive. Now, some people will argue that you can set up a corporation for a relatively small financial commitment, and that's true, but when you do it yourself with these kinds of things, it's sort of like writing a will yourself. You're really maybe giving up some of the advantages when you don't take into account all the possible considerations that you should take into account. You have an initial cost of setting this thing up, and then you have some annual requirements. You have to file corporate returns annually. So whatever jurisdiction you've incorporated in is going to want to know that your corporation is still doing business, still alive as it were, and it's going to require corporate returns, and then also we're going to have tax returns that have to be filed each year, and those can be a little bit more cumbersome than your typical personal return. Now, this is debatable, but some people would argue that a corporation represents a loss of control or a potential loss of control, and this can happen in some cases where we have our shareholder who incorporates a business, and then we have some directors here, and maybe we bring in some more shareholders, sell some shares, and those other shareholders don't agree with us and end up appointing a board of directors that doesn't necessarily support what we do. So you can have this potential loss of control, and on the whole, it's just a slightly more complex structure than just owning assets personally and running things personally. So those are the basics of incorporating, or the basics of the corporation. We will talk about more of the detail around the corporation in a later set of videos. I hope this has been helpful, just to give a basic understanding. This is sufficient at the level for those going through a life insurance course or for the mutual funds course. If you're in a financial planning course, then you're going to have to delve into especially issues around salary or dividends, the ability to defer income. There's much more to discuss in a financial planning course, and we will talk about those issues in a later video, or later videos, sorry. So I hope this is helpful, and enjoy your continued studies. Thank you.